In the 1970s, the British and French governments knew the Concorde supersonic jet would never be profitable. The economics were irreversible, the math was clear. They kept funding it for another 30 years anyway. Not because new evidence changed the analysis, because they had already spent too much to stop. Economists named this the Concorde fallacy. You already know it as the sunk cost fallacy, and it is quietly destroying your financial decisions right now, in your investments, career, debt, and relationships with money. Here's exactly how. Picture this. You bought a stock at $48 per share 18 months ago. It's now trading at $19. Every rational signal says the thesis has broken. The company's fundamentals deteriorated. Better opportunities exist for that capital. But you don't sell, not because of new analysis. Because of 6 words your brain keeps producing. I've already lost so much. That sentence is not financial reasoning. It is a cognitive error that every human brain generates automatically, including the brains of portfolio managers, CFOs, and economists who have studied this exact error in graduate school. The sunk cost fallacy is not a knowledge problem. Intelligence doesn't protect you from it. In some cases, as we'll see, it makes it worse. A sunk cost is any cost that has already been paid and cannot be recovered regardless of future action. The money is gone, the time is gone, the energy is gone. In classical economic theory, sunk costs are irrelevant to rational decision-making. Only future costs and future benefits should determine your next move. The decision you face today is never, how do I justify what I've already spent? The correct decision is always, given where I am right now, what is the best path forward? These are different questions, and your brain almost never asks the second one. In 1985, psychologists Hal Arks and Catherine Bloomer published a study at Ohio University that became the foundational paper on sunk cost behavior. They gave participants a scenario. You've spent $100 on a ski trip and $50 on a different ski trip for the same weekend, realized too late to get refunds. The $50 trip is objectively more enjoyable. Which do you attend? 54% chose the $100 trip, the one they enjoyed less because of the higher prior investment. They sacrificed a better experience to honor a cost that was already unrecoverable regardless of their choice. The economist's term for this error is precise. The sunk cost fallacy, allowing past, unrecoverable costs to distort forward-looking decisions. Here's what makes it genuinely dangerous. The distortion is not random. It consistently biases you toward the worse option, because the worse option usually involves the higher prior investment. The fallacy doesn't just cost you money. It costs you the money and the better outcome. To understand why the sunk cost fallacy is so sticky, you have to understand the mechanism driving it. That mechanism is loss aversion. In 1979, Daniel Kahneman and Amos Tversky published Prospect Theory in Econometrica, one of the most cited papers in the history of economics. Their central finding: losses feel approximately twice as painful as equivalent gains feel pleasurable. Losing $500 registers with roughly twice the psychological intensity of winning $500. This asymmetry is not philosophical. It is neurological. The amygdala, your brain's threat detection system, processes financial losses using the same circuitry it uses to process physical danger. Selling a losing position doesn't just feel financially painful. At the neurological level, it triggers a threat response. And here's how loss aversion powers the sunk cost fallacy specifically. When you've invested $10,000 into something that is now worth $4,000, selling crystallizes the loss. The $6,000 loss becomes real, permanent, registered. As long as you hold, the loss exists only on paper. It's still hypothetical, still reversible in your mind. Even when the fundamentals say it isn't, holding the position is not optimism. It's loss aversion producing a behavioral pattern. Continued investment that feels like it might prevent the loss from becoming real. It doesn't prevent anything. It just delays the accounting while the underlying position continues to deteriorate. The sunk cost fallacy is loss aversion in a costume. The costume is called staying committed. There is a more severe version of the sunk cost fallacy. It's called escalation of commitment, and it's the reason sunk costs don't just hold people in place. They push people deeper in. In 1976, Organizational psychologist Barry Staw at UC Berkeley documented a pattern he called throwing good money after bad. His research found that decision makers who were personally responsible for an initial failing investment allocated significantly more resources to that investment than decision makers who had inherited the same failing position. The personal responsibility variable was critical. When you chose the investment, abandoning it isn't just a financial decision, it's an identity verdict. Selling the losing stock says, I was wrong. Staying in the losing stock says, I'm waiting for the market to recognize my thesis. Stahl later coined the term escalation of commitment, the tendency not just to continue failing courses of action but to increase investment in them over time. This plays out in your financial life with precision. You take out a personal loan to invest in a friend's business. The business underperforms. Instead of recovering whatever capital remains, you provide additional funding, because pulling out now means the original loan was a mistake, and you made it. You've been in a graduate program for 3 years in a field that no longer aligns with your goals. You complete the program anyway, at significant cost, because leaving now makes the 3 years feel wasted, but the 3 years are already spent. They will be spent whether you leave or stay. The only variable is what happens next. Escalation of commitment is the sunk cost fallacy with your ego added to the investment. It is structurally more expensive and considerably harder to exit. Here's what nobody tells you about the sunk cost fallacy. It operates across every financial category simultaneously. Investments. You hold a losing position past every rational exit point. The sunk cost is the capital already lost. The ongoing cost is the opportunity, capital trapped in a deteriorating asset instead of compounding somewhere with better fundamentals. Housing. You stay in an apartment you can't stand because you just paid $3,000 in moving costs 6 months ago. The $3,000 is gone regardless. The ongoing cost is 12 more months of diminished daily life plus the psychological toll of a poor living environment. Career. You stay in a job or industry that has structurally changed because you spend a decade building credentials for it. The decade cannot be unlived. The ongoing cost is compounding years and a declining trajectory when a lateral shift might redirect that experience productively. Debt. This is where the fallacy gets genuinely dangerous. A 2018 study by Drazen Prelick and Duncan Simster found that credit card spending decouples purchasing pain from the transaction. People spend significantly more when paying with credit than with cash. The prior spending on a credit card becomes a sunk cost. The balance already exists. And because the loss aversion around that existing balance is already priced in, already emotionally registered, adding to it feels proportionally less painful than the initial spend did. This is why high-balance credit card holders disproportionately continue accumulating debt rather than halting and paying down. The first $3,000 was agonizing. The next $500 barely registers. The sunk cost has recalibrated your pain threshold downward. And your spending follows. The sunk cost fallacy is not a flaw that markets ignore. It is a revenue model that specific industries have built their architecture to exploit. Let's start with the most explicit example. The casino industry has a documented pattern called chasing losses. Gamblers who are down do not bet at the same rate as gamblers who are even. They bet more frequently, higher stakes. Because stopping now means accepting the loss. Continuing means the original loss might be recovered. Casino floor design, no clocks, no windows, drink service on the floor, is not hospitality. It is environmental friction reduction for a sunk cost trap. Gamblers are not staying because they're winning. They're staying because they've already lost. The streaming and gaming industries run the same mechanism at lower stakes and higher frequency. Streaming platforms autoplay the next episode because the sunk cost of the episode just watched generates momentum toward the next one. You're not choosing to watch episode 4. You're declining to stop, which feels different at the neurological level because you've already invested 47 minutes in the narrative. The sunk cost is time. The ongoing cost is sleep, productivity, and the cascading financial decisions made under chronic fatigue. Enterprise software pricing exploits escalation of commitment precisely. A company implements an expensive software platform. Employees are trained on it. Workflows are built around it. 3 years in, a significantly better alternative exists at lower cost. The switching cost, real, in time and training, is meaningful. But the sunk cost of the original implementation inflates the perceived switching cost far beyond its actual value. The software vendor knows this. Renewal negotiations happen in that gap between what switching actually costs and what sunk cost psychology makes switching feel like it costs. In 2023, Gartner estimated that enterprises overspend on software by 25% specifically because of implementation sunk costs driving renewal decisions. Here's the systemic conclusion. Sunk cost exploitation is not confined to casinos and bad stocks. It is built into the renewal architecture of subscriptions, the retention mechanics of streaming, the momentum systems of consumer debt, and the escalation structure of enterprise contracts. In every case, a prior investment is leveraged to make continuation feel obligatory and exit feel like loss. Your psychology is the product. The sunk cost is the hook. The sunk cost fallacy cannot be eliminated. Loss aversion is neurological, not educational. You will feel the pull of prior investment for your entire life. But there is a specific cognitive intervention that research shows reduces sunk cost errors significantly. It is two questions, written down, asked in sequence, every time. Question 1. If I had not already spent the money, time, or energy, would I choose to enter this investment today? Not, does it feel wrong to exit? Not, how do I justify what I've spent? Would you choose this, starting fresh, today? If the answer is no, and you're honest, the prior investment is irrelevant. It was always irrelevant. You've just made that fact visible. Question 2. What is the best use of the next dollar, the next hour, the next decision, independent of everything that came before it? This question is the formal application of what economists call opportunity cost thinking, evaluating choices based on what you forego, not what you've spent. In 2000, Shane Frederick, Nathan Novemsky, and colleagues at MIT ran experiments showing that explicitly prompting opportunity cost thinking reduced sunk cost decision errors by 50% in controlled settings. The prompt is not complex, it is just, what else could this next resource accomplish? That question redirects attention from the past, which is fixed, to the future, which is the only dimension where decisions matter. Write these two questions on a card. Put the card wherever you make financial decisions. Use it before selling, before staying, before renewing, before extending. Specifically before any decision where a voice in your head says, I've already come this far. That voice is not wisdom. It's a cognitive error wearing the mask of commitment. Here's the one-sentence summary. Every dollar you've spent is gone. The only question that matters is what the next dollar should do. And the sunk cost fallacy will spend its entire existence trying to prevent you from asking it. If this changed how you think about financial decisions, subscribe. Every week on this channel, we go deeper into the psychology behind every financial decision you make.